Good morning, everyone, and welcome to another installment of the Prosperity Through Multifamily Real Estate Investing Podcast. I am your host, Real Estate Cody, and with me, as always, the coffee connoisseur himself, Mr. Brian Alfaro. Brian, you've been feeling a little under the weather, man. How you doing today?
I'm hanging in there, surviving. Excited to be on another podcast episode. Hopefully I make it to the end of the show, but no, just kidding aside, I'm doing good.
You look a lot better today, man. I'm glad you're feeling better. It seems to be going around. There's a bug kind of going around. People are kind of getting a little ill. Kids are back in school now, so
Mm-hmm.
I'm sure that's a culprit. But I'm glad you're up on the up mend, so to speak. So, and it's good to be back here in the hot seat, man. It's been several weeks since we've actually done a recording. So it's good to be back here having just a good conversation. What do you think?
Yeah, doing lots of projects to grow our business and continue to add value to our listeners and all of our followers and people that do business with us. So working on some good stuff. That stay tuned. Don't give too much away, but yeah, it's kept us out of the hot seat for a little bit, but that's okay. School's back in session, like you said, and I'm sure you've been very busy with your kids, and we're about to go into the fall, so we'll see what happens.
Yeah. Look, love my kids, man. They're absolutely incredible, but it is incredibly challenging and another full-time job to keep them entertained during the summer. So it's good that everybody's back in the school routine and they're back in a good schedule. So
Yep.
yeah, but well, cool, man. Well, today we don't really have any predetermined topic. Today is just going to be just a good casual conversation about really what we've been seeing in the market. Like I said, we've been incredibly busy in our business, and so kind of talking about what's been happening around us, and then kind of seeing where the conversation leads from there. But it's definitely no secret, it's definitely some interesting times that we're in. I think the real estate market has seemed to change week by week, month by month, and it is a completely different landscape now in what are we, August of 2022 versus where we started the year in January of 2022. And I mean, even for the experts, even for people that have been in the industry for many years, it's got a lot of people bewildered right now, wondering what does the future hold. And we're hearing a lot of interesting feedback and angles from other people's experiences, right? And how they're proceeding with their business. So what do you think? What are your thoughts on that?
Yeah, right now there are a lot of interesting things going on in the real estate space, and in our opinion, it is not the time to be sitting on the sidelines. Now, when we're not saying you should be buying everything, but what we're saying is you definitely need to be engaged. You need to be talking to your brokers. You need to be talking to your investors. You need to be talking to your lending partners, everybody that helps you get a transaction done. Because if you're sitting on the sidelines and you're totally disconnected from what's going on in the real estate space right now, you're missing the boat because things are moving so fast. When we closed our property in February to now, it's a totally different landscape. So I think it's super important we cover this topic today and really highlight what people need to be paying attention to and what we're seeing in the market.
Yeah, you're absolutely right. Because I think a lot of people are driven by fear right now. A lot of people are reading in the headlines and they're turning on the mass media outlets, and all you hear is doom and gloom. And what you're missing is really the underlying principles and fundamentals of what we do as real estate investors. And we, Brian, I know you and I live by this quote, right? Where time in the market always beats timing the market. And I think that's where you're seeing a lot of groups now is putting pencils down and saying, hey, we're going to wait until the dust settles, and we're going to wait till the bottom hits, or so to speak. But the reality is nobody has that crystal ball, right? Nobody really knows where this market is going to end up. And I mean, we all have our own speculation, but at the end of the day, if you're not, like you said, if you're not in the market, keeping your finger on the pulse, talking to the professionals, talking to the advisors, talking to the people that are in the weeds every day, there's really no way that you're going to really know what's actually happening right now. And so I think you made a very good point already, is that, yeah, you need to be very active in the market and very visible in the market right now, and for the first time in a very long time, when it comes from the transaction side, we're now in a neutral environment, right? It's no longer a seller's market. I'm yet to really lean to it's a full-fledged buyer's market, but you're actually in an environment where negotiations are occurring again across the table, right? Where there is a price guidance, but the price guidance has flexibility. And you can have tangible feedback with the sellers and the brokers to come up with a valuation that makes sense for both parties versus just saying, here's price guidance plus 10% just to even get into a best and final round. And if you're lucky enough to make there, then you got to push another couple million, right? So I think just from the transactional side, people need to understand that now is an amazing time to be speaking and building those relationships with the brokers and analyzing deals, because you might be surprised that you can find some quality real estate at a cost basis that actually might make sense right now. You're not having to stretch and get too creative in how you're going to create value in your future pro forma to come up with the values that the brokers were pushing several months ago. And if there's any positive light of this market cycle that we're going through now, especially in the capital market side and the volatility, it has definitely reset expectations, or is persistently resetting expectations for the market in a good way. And I think it was a much needed reset, because the iron was hot for, I don't want to say too long, but the iron was very, very hot for a while. And so it's good. It's a good reset for everybody to experience it. That way we can get back into this more of a what I call a neutral environment.
Absolutely. There's a famous saying by Warren Buffett. He tells investors that you should be fearful when others are greedy, and you should be greedy when others are fearful. Well, right now, there's a lot of really fearful people in the market. So it's a great time to go out there and build your business. This is exactly how we got our start, late 2019, early 2020 during COVID, and came out guns blazing in 2021 with the capability to grow our portfolio and really add a lot of value to the real estate market. So that famous quote is what we're seeing in the market today. And it's a great opportunity to go out there, and all the things you highlighted are just setting the foundation for why, even though others are fearful right now, you're seeing all the news headlines, the stuff online about real estate crashes. I'm like, well, when the market goes up 40% and goes down 10%, I wouldn't necessarily call that a crash. You're still in a pretty good spot, right? So you can't just buy into all the propaganda that the media is talking about and how things are crashing, and we're going to see what we happened in 2008 happen all over again. It's an entirely different market or an entirely different cycle. If there is some sort of correction, if we are truly in a recession, the government keeps changing the definition of what a recession is every time the Fed comes out. But if we truly are in a recession, we're living it right now. We're already in it, and we might ride it out for the next 6-12 months. But now is a phenomenal time to be greedy. Go out there, build your business, talk to investors, talk to vendors, and really set the stage so that when you come into 2023, 2024, when we do start to see those interest rates decline, you're going to be off to the races. You're not going to be waiting, because if you're waiting to jump in before the headlines turn, guess what? That's what a lot of other people are doing, and you're going to be behind the boat, because guys like you and I are going to be ready to go.
Yeah, it's too late. That's right. And I think back to previous downturns and economic cycles, previous recessions, right? And you think about all the people that we've talked to in our career that have always said, oh, I wish I would have bought during the great financial crisis. Oh, I wish I'd have bought through COVID. Oh, I wish I'd have bought through whatever. And people are going to be saying the same thing about this year. Oh, I wish I'd have bought in 2022 when the capital markets fell to pieces. And I think when we're talking about, again, expectations, we've lived in this fantasy land for too long now, where people have just become to expect that you're going to become overnight millionaires, or not necessarily overnight millionaires, but you're going to, double your investment and double your wealth in 24, 36 months, because that's how deals have been trading, right? And you and I, we've been benefactors of that. I've been a benefactor of that as both an LP and GP. And although it's great, that's not reality. We've seemed to have forgotten, until times like we're in now, where fundamentals of real estate have always been based on a patience type game and investing strategy, right? Your wealth in real estate is built on the long term. You buy real estate and wait, not wait to buy real estate. And I think right now, as we've already alluded to, man, there's a lot of great opportunity out there still. Now we are seeing the deal pipeline slow down. I think, you saw a rush of deals to the market. We saw the highest transactional volume last year. That also Q1 this year also resulted in one of the highest recorded transactional quarters for commercial real estate, multifamily in particular. But I think what you saw is a lot of those buyers, or excuse me, sellers that kind of were expecting the market to unfold the way it has, and they were trying to get ahead of that. Let's get our deals to market now. Let's get them off our book so that way we're not in this volatile period. And then you had a few sellers that were kind of lingering around, and the market's changed. And then, now we've seen every deal being retraded, long extended closing timelines, 3-4 months to get deals done. And now I think what you're seeing all the deals that were trading just because they wanted to take advantage of the market now are have transacted. They're off the books. And then now the few remaining deals that you have, you might actually find a distressed seller or a seller that is in a situation where they're motivated to sell right now for whatever their circumstance. Maybe their debt is coming due, their notes coming due, maybe they're in a bad partnership, maybe their financials are not where they need to be and doesn't look like they're going to get any better or something like that. But I think the deals that you are seeing kind of remaining on the market are there's a little bit motivation there. But the point is again, those are the opportunities that you really want to pick up right now. Those are the opportunities that you really want to be looking at right now, because if you buy and hold those assets for 3 to 5, 7 years, you have the potential to be a very, very happy investor. And it could change the entire trajectory of your portfolio and your investment career.
Absolutely. Nobody has that crystal ball. It goes back to your saying, just got to buy real estate and wait, make sure you have the right investing thesis, you're using the right debt, you're buying the right product that's going to outlast your business plan, and go out there and execute and just go try to make things happen. Because we can only plan in pencil, right? We can't plan in pen and permanent marker, whatever you want to call it. Things change very rapidly. Nobody saw 2008 coming. Nobody saw the great financial crisis that happened then, and nobody saw what happened in COVID coming. Nobody could have ever underwrote that on a spreadsheet. And whatever happens next, it's very similar, right? We don't know what's going to happen. It could have nothing to do with real estate, just like COVID, but have a drastic impact on our business, or maybe it doesn't. But that, long story short, go out there, buy good real estate in good locations, use the right debt product, make sure to aligns with your business plan, and good things tend to happen because time is on your side.
Yeah. There was, we heard someone recently mention this, and I forget where it was at, but it was a great remark. And they were referencing the predictability when it comes to economic cycles. And the remark was along the lines of the greatest recessions or economic downturns come from circumstances that we can't predict, or we don't foresee. And if you think about that, take the great financial crisis right now. There were a few people that predicted, like, okay, yeah, there was some, malpractices in the credit markets and such, but nobody would have predicted that, the credit market would have completely crumbled and the way it did, and had such a global impact, right? You take COVID, like you just said, there's not a single person in the world could have predicted that COVID was going to have any significant impact on the global economy, population, all the above, right? I mean, all of those things were unpredictable circumstances. The war in Ukraine was another example of that. Maybe inside military forces or personnel may have had an indication of what was going on, but I mean, really, I had no idea what was going on between Russia and Ukraine before February of this year. And all of a sudden, boom, one day, Russia's invading Ukraine. So, and then look what it's done to, have an impact on commodities and, global economics and things like that. And my point is I think when you look at the circumstance that we're in today, we see what the Fed is doing. We see the Fed monetary policy. We know what they're enacting to combat inflation. And we know the impact that has. So it won't be a surprise 12, 18 months from now when we see the results of the interest rates from today, right? So everybody's going to act surprised when it gets here. But the reality is we know what the Fed is doing. So I think people need to keep that in mind, is that you can't always try to sit here and time the market when you already know what's happening, right? We know what's in front of us. We know what's being impacted or influenced. And so, but you also can't be fearful of the unknown as well. And so I don't know. I just thought it was a really relevant topic that was, or conversation that was made, and it's something that I've taken into definitely consideration as we look forward here. It hasn't changed our thesis. I mean, you and I both believe in the power of real estate and buying and staying persistent, in whether you're in a top of the market or the bottom of the market. But I definitely, to your point, which we made over and over already, is you got to stay active right now. You have to be in the market right now.
Absolutely. Yeah. And staying active. I mean, that's your foray, Cody. You're the one dealing with the brokers and the lenders and all that stuff. So why don't you speak to us about what you've seen in the market, being on the acquisition side? What are you hearing from brokers? I know we went to a great breakfast the other day. We're strengthening our relationship with brokers, but also you're touching base with our lenders on a regular basis. What are you hearing about today's market?
Yeah, I mean, look, brokers know, they're very well aware of what's going on in the capital markets. They understand the challenges and the headwinds that buyers are facing when it comes to securing debt that they need to go acquire these assets, right? And I think for the broker side, they've, over the last several years, I don't want to say their job has been easy. So if any of our broker friends are listening in, sorry, but really it has been a lot less effort to go out and sell commercial real estate, right? Because it's been such a seller's market. Hey, you put a property on the market and you're going to have 30 buyers lined up. That's just how it's been. Now they're actually having to be an advisor. They're actually having to be an advisor to both the sellers and the buyers, and to the sellers, they're having to really advise the sellers, like, listen, this is the headwinds that buyers are facing. This is the challenges that the buyers are facing. So if you're bringing your property to market today, and you have this price expectation, you might need to adjust that a bit, because there's no way that a buyer is going to come in and be able to execute on that. So it's kind of managing expectations for the brokers, right? And they have an obligation to the seller. They're still going to go out there and try to find the best buyer for the best price. But the reality is they're very well in tune to what's going on in the market. And for them, this is their livelihood as well, right? I mean, they're 100% commission based. They want to go out and continue to put food on their table. So they want to go out and continue to find sellers that want to sell. But I think you're seeing, again, for the first time in a very long time, where brokers are being very open to feedback. They're being very receptive to feedback. They're being very flexible in negotiations between the seller and the buyer, right? And on the debt side, I mean, it's no secret. I mean, the interest rate environment is having a massive impact for all of us as prospective buyers. I mean, we're constantly seeing the Fed fund rate continue to escalate. I think expectations are still that it's going to land around 350 basis points before the end of the year. You're seeing the 10-year treasury that's now kind of floating around 3%. And so you're seeing spreads now that are kind of starting to I think, level out, so to speak. So you're seeing your fixed rate equivalents kind of being pretty predictable right now. The short-term rates, if you're going on a bridge debt or variable rate debt, there's still a lot of volatility there, and you're seeing a remarkable increase in your short-term rate. So that is having a massive impact. But you're also seeing leverage come down, which is also having a massive impact. So it's impeding our ability to go out and execute deals at purchase prices that we were seeing in Q1, Q2 of this year. And so, and again, that's no secret, and the brokers know that. So brokers are now calling buyers back, right? They're making calls to people to say, hey, I've got an opportunity you want to look at, or hey, are you going to put an offer in? And you're starting to see, the flexibility, not just on the terms when you're putting out an offer, but closing expectations, like, hey, we now need 60 to 90 days at least, to even consider getting this closed. And before is like, man, if you couldn't close in 60 days, you don't even have a chance. So, the point is that I think right now brokers are very, very much in tune with wanting to work with prospective buyers, especially that are active now, because there are still transactions that need to get done. But expectations from, especially from the seller side, are starting to come and adjust a little bit to where, there's still opportunity there. So it's been fun. It's been an interesting time. It's been really good to kind of be back again in this environment. It's nice to go into a best and final and be one of three in the best and final and not 12 and have to go through multiple rounds, right? It's nice not to have to put at risk capital day one without ever seeing or stepping foot on the property to do your due diligence. That's been a big relief. I mean, earlier this year, we were underwriting deals and putting up $500,000 hard day one that were inking the PSA. And then now, now you're back to traditional, hey, our risk capital goes hard at the end of a feasibility period, which is now 30 days again. So, it's definitely moving more towards the buyer's favor. The buyers definitely have more leverage when it comes to negotiations right now. So, and the brokers are being very receptive to that. So
It goes back to the point of why you have to stay active. All the stuff that you just highlighted, Cody, if you're not active right now, you would never know that, right? You would never know that the tide is shifting. Where I hate, again, not to say it's a buyer's market, but it's becoming more neutral, which gives you an opportunity, if you can close, to go out there and buy deals. But if you don't have these relationships and if you're not staying active, you're going to miss it.
yeah, you're absolutely right, 100%. So that kind of leads us to a point where you were making earlier, right? Like, hey, what should we be doing right now then in this market cycle, with deal being slow, with the capital market headwinds, right? Well, what you just alluded to, you absolutely should be developing relationships and building on the relationships you have with your brokers, your advisors, and your debt team, right? Your capital markets guys. Like, you really need to be honing in on those relationships and engaging with them as often as you can. Because the other thing too is, there may not be a lot of deals that are coming to market in volume, but there may be a handful of deals that may still be going off market, right? And by motivated sellers. So there's still going to be opportunity if they know that you're still visible. But the only way that you're going to do that is if you're engaging with them and building on those relationships. The other thing I think is really important right now is you really need to be in tune and engaging in your investor network, which is so critical right now, right? We've heard how many shops, Brian, have we talked to that we know personally that have had issues with capital raising, right?
Oh, yeah.
Every deal that we know, every sponsor we know has had trouble raising equity right now, and rightfully so. Investors are scared. So you need investor relations, in my opinion, has never been more important than they are today. You need to really be talking to your investors and understanding what their risk appetite is, what are their concerns, what are their fears. Has their investing thesis changed at all with the cycle? And I know that you do a lot with that for us. Tell us what you're hearing from the investor side.
Yeah, you're hearing the stuff you just mentioned. I mean, a lot of people that don't do what we do on a daily basis, they get their information from the media, which, as we all know, does not do a good job of giving you the warm and fuzzy, so to speak. They're gonna paint a doomsday picture a lot because that's what gets clicks. That's what sells headlines, so to speak. So if you're reading anything on the media, traditional outlets, you're gonna read about a lot of bad things that are happening in the market. Obviously, the commodities market, the stock market, equities market, all that stuff's down. The crypto market is down, and then real estate, it's not down, although the media may portray it that way. I mean, again, up 35-40% one year and down 10% the next year. It doesn't mean it's down overall. It's just last year was such a record high for all types of transactions. Obviously, multifamily being one of the leaders, but everything from industrial to residential, single family housing, it all transacted last year. So of course it's going to be down compared to 2021. But if that's where you're getting your information from, you might think it's a terrible time to even look at real estate right now. Well, you just mentioned all the stuff you just said. It is hard to buy real estate right now, but if you have the right investing thesis and you're looking at real estate as a long-term wealth, wealth shelter, tax shelter, wealth preservation tool, and you're not looking at it like you just said earlier, where a lot of investors have gotten spoiled and they want to stick their money in, they want to give you $100,000 and expect it to double in 24 months or less. As long as you don't have that investing thesis, you're going to be just fine. And real estate's a great place to, park your capital. So we're hearing that theme. I haven't personally talked to a lot of investors that have said, hey, I'm kind of sitting on the sideline right now, at least our investing partners, what they're saying is they're being more selective, right? Which is has been our thesis that we switched to, call it 18 months ago or so, where they're being more careful about the types of deals that they are looking at, because we all know that when times are tough in the market like they are right now, the tenants, the residents, the people that get hit the hardest are the people that are going to be in that affordable housing, that workforce housing space, right? So for us to go and buy a property, no matter what the price is, no matter what the terms are, could be an amazing deal on paper for us to go in there and try to renovate the units and then bump the rents 150, 200, $300. I'm not saying it's not possible. Is you have to be hyper careful and hyper selective about where you're doing it, what market you're doing it, and if the demographics in the area can actually absorb that. And I think smart, savvy, sophisticated investors like the people we like to work with, they know that, they're aware of that. So they're just being more selective with their types of opportunities. They want to see higher quality deals. They want to see newer vintage things. They want to see things that are they know can sort of weather a storm, so to speak, if we are to go into some sort of extended type of recession, assuming we're already in one. They want to see a demographic that can absorb that type of hit, and that aren't a one income household where they got people living in a small apartment that can sort of get by paycheck to paycheck. So investors are still active, from what I'm hearing. I haven't talked to anybody that's not investing at all. They're just being hyper selective about what they're investing in, which aligns perfectly with our thesis. And I think they're still, and we're still working hard to provide some opportunities for them later this year.
Yeah, you're absolutely right, man. I don't know that I've heard anybody, particularly in our network, that has said, "Hey, absolutely not. We're out of the market right now until next year, or whenever this settles." But yeah, you're absolutely right. I think they're being very, very selective right now, and rightfully so. And you brought up a really good point here, and this is another thing that people really should be doing right now: is you really should be studying um, demographic trends in your target markets and how they're being impacted by this inflationary environment, because we have been seeing that, right? And we have a divided portfolio. We have a couple of workforce housing deals, and we have a couple of A-class deals, and the demographics between the two are being impacted in two completely different ways, right? and and that's very, very important for people to understand, right? If you're a workforce housing investor and you're looking for the value add strategy, you want to be very, 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 very careful right now, because that demographic is being impacted the hardest, and it will affect your ability to go and execute your business plan right now, with the cost of capital and the basis that you're still going to have to buy at. And so you can't get bought into the hype of rent growth to the moon for perpetuity across all demographics. So good point that you made there. But yeah, I mean, look, and the last thing I would tell you, if you're sitting around wondering, man, what am I going to be doing right now? You really should be taking a look at your business and figuring out what are some aspects of your business that you can work to improve on. And right, maybe it's your CRM, your investor engagement, maybe it's your automations, maybe it's your systems and processes that you have in place. Something. Now's a perfect time to take time and reflect on your business, and really sharpen up the things that probably haven't been priority because you've been trying to keep up with the pace of the market. Now would be a good time to really reflect on your business and really get those things ironed out and sharpened up, so that way when things do pick back up, and which I know you and I talk about this all the time, I mean, it's going to happen, right? I think the Fed, once they take their foot off the brake and we start seeing interest rates cool down a little bit, especially if there's any indication that they're going to stop rising interest rates, you're going to see this capital inflow coming right back into the market, and it's going to be a competitive environment again. So I think right now is a great time for people to really focus on the infrastructure of their business, and so that way they can position themselves to be ready to capitalize on that when the momentum picks back up. So
Absolutely.
but, well, good deal, man. Awesome conversation, bud, as always. I know this one was short and sweet, but I definitely hope it helps a few people put things into perspective about what we're seeing in the market, and what we're doing. We're not going to shed too many insights just yet, but we have a lot of exciting things happening at Blue Oak Capital. I think a lot of people are going to be excited to hear about over the next coming weeks and months. But yeah, definitely stay active. Right now is definitely the time to be active. So yeah, man, good conversation. Hope you feel better, man. I know you got a doctor's visit here right after this. So, but I guess we'll catch you next week.
Absolutely. Look, hopefully this added a lot of value to everybody, and we'll continue to bring some good content to the show. But I will see you shortly, Cody.
All right, man. Take care, everybody.